This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. Stock markets remain under pressure as AI concerns triggered a sell-off in tech stocks. The Dow fell 669 points, or 1.34% Thursday, to close at 49,452, while the S&P dropped 1.57% and the Nasdaq plunged 2.03%. Today at 8:30 a.m. Eastern, the Consumer Price Index for January 2026 releases, and markets expect core CPI at 2.45% year-over-year, down from 2.6% in December. Cisco Systems tumbled 12.3% on weak guidance. Apple slid 5% in its worst session since April, and Amazon, Meta, Broadcom, and Palantir each dropped between 2.3% and 4.8%. Investors began to worry about the negative side of AI build-out, which threatens to disrupt business models of whole industries and raise unemployment. The tech sector faces mounting skepticism. Growing doubts over artificial intelligence monetization triggered a broad sell-off, as analysts note that large-scale monetization remains gradual. Volatility in AI-exposed industries reflected rising skepticism about the scale and returns of capital expenditure for compute infrastructure. Meanwhile, economists expect January CPI to show continued inflation. Headline CPI forecast to rise 2.5% year-over-year after increasing 2.7% in December, while core CPI is forecast to rise 0.3% month-over-month. Markets are pricing in a 93.6% probability of a 25 basis point rate cut in June bipartisan. AI is threatening business models across whole industries. Certain pockets of the stock market have been hit on the release of AI tools that could replicate their businesses or eat away at profit margins. This isn't temporary volatility. The market is repricing which companies survive AI disruption and which don't. The Fed's quest for a soft landing is entering its most delicate phase, with falling shelter costs competing against rising tariff pressures. If today's CPI comes in at or below 2.5%, the stock market should climb higher on investor hopes for additional Federal Reserve cuts. But if inflation stays sticky, rate cuts get delayed and tech stocks face further pressure. If you own tech stocks, brace for more volatility. Software and select financial names are under pressure amid fears that automation could disrupt established business models. Consider whether your portfolio is too concentrated in AI-exposed companies that may face margin compression. Today's CPI report determines the Fed's next move. Lower inflation means potential rate cuts in June, which helps mortgages, auto loans, and credit cards. Higher inflation means rates stay elevated longer, keeping borrowing costs high. Defensive shares outperformed Thursday. Walmart rose 3.8% and McDonald's gained 2.7% after earnings. If markets stay volatile, consumer staples and defensive sectors offer safer ground than high-flying tech. Watch the CPI report at 8:30 a.m. today. If core services show rent and insurance costs continue to moderate, the path to a 2% target remains viable. Above expectations signals sticky inflation and delayed rate cuts. Watch the 10-year Treasury yield closely. A move toward 4% would signal loss of confidence in the Fed's ability to cut rates, while a yield drop would signal mission accomplished for the disinflationary trend. And watch tech earnings this week. If more companies warn about AI disruption to their business models, the sell-off continues. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.